Like you said, a lot of brokers have that problem. But, Robinhood, from the way I look at it is, and we've been following these guys and talking about them for years now. We actually wrote our first piece on Robinhood even before they did their first trade because we saw them coming. We said, oh, look at this. It's a free model. Free. How do you trade for free, right? How do you trade for free? Well, we looked, and the two founders are actually ex-HFT guys. They were high-frequency trading pedigree. So they knew how the system worked, right? In our opinion. They knew the plumbing. And the main part of the plumbing of the stock market, and this is what everybody has to understand, is payment for order flow is embedded in the stock market. Everywhere you go, there's payment for order flow, whether it's a market maker paying for that retail order, or it's a stock exchange paying a rebate to get liquidity on their exchange. These are both very distortive processes. Order routing is distorted. Algorithms go where they get the best price. Retail brokers go where they get the most payment for order flow. And what happens is these orders are being intercepted before they should get out to the general market, before the real price discovery process should start. And that's why we have these problems. So again, we would always argue that payment for order flow is a bad thing, should have never been in the market in the first place, and it should be banned. And I hate to use the word banned because I'm a free market guy, but this is a practice which distorts things, and it doesn't need to be there. We can have a market without payment for order flow and we'd still be fine.
I mean, this is, something I've argued to the regulators for a decade here, and the argument that comes back at me is that, well, yeah, but everybody wants free commissions. How do you do free commissions without payment for order flow? What do you say to the person, that says, how do we do free commissions then?
Okay, but maybe the market really shouldn't have free commissions.
I agree with that. That's what I argue back.
Right. What's the market rate? Someone's getting paid. The market rate, no one's doing anything for free, guys, right? I hate to say it. There's no free lunch. I learned that in economics as well. So I got two things, the price, supply, and demand line, right? And I got no free lunch. They're not doing it for free. You got to pay. Someone's got to pay. And the way it works right now is the retail broker collects a nice VIG from the market maker. Why does the market maker do that? Let's think about that question. Well, because they want to see all the flow. And the more flow they see, the more they can direct and figure out which way the markets are going. And it's a bigger picture. It's not about your one order in XYZ stock. They could care less about that one order. They want to see the whole picture so they can understand where retail's going, where's institutional, and that's put into a much bigger model, way beyond the scope of what we're talking about here. The prices, by the way, hundreds of millions of dollars Robinhood made last year from payment for order flow, as well as other brokers. They all the retail brokers, and this is easily available. You can all look at it. Everybody online, look up a 606 report, and you can see any one of these retail brokers and how much money they're getting paid or they're paying. Now, here's an interesting point. Robinhood has no exchange membership. They're not a member of New York Stock Exchange, NASDAQ, CBOE, none of them. And you can look at the FINRA broker check to confirm that if you don't believe me. They only route orders to market makers. So that tells you they're beholden to the market maker. They have to go to the market maker. But the market maker, on the flip side, loves that order. He wants that order. So they've got this nice relationship going. But what happens if they want to route out to an exchange? Well, they can go to the market maker who would bypass it to the exchange. But now you got fees, because every time you go out and take a offer from an exchange, you have to pay. Yeah. Okay. It's called the maker-taker model, right, Dennis? We've talked about that many times. And that's another problem that's being lost here. The stock exchanges are, by the way, they're getting a free pass, by the way. They do not get a free pass, in my opinion. They are still at the center of the rebate. In fact, we were going to have a transaction pilot last year or the year before. The SEC recommended, hey, let's get rid of these rebates. And guess what? The industry shot it down. The stock exchanges lined up and sued the SEC. So all you guys on Reddit and all you guys on Wall Street Bets, you want to find the culprits? You want to find the real guys who are controlling the system? Go look at some of the SEC files. Go look at some of the legal aspects. Go look at the lawsuits that these guys will file to make sure that their business model stays the way it is. Those are the guys you want to take a look at.